Imagine someone hands you like a corporate report card and the numbers are just so flawless, it almost looks fabricated.
Right, like they made it up.
Exactly. But that is the actual situation Travelers Insurance just presented for their second quarter of fiscal year 2026. Let me hit you with the raw data really quick because it really sets the stage here.
Yeah, lay it on us.
Okay, so core income came in at $2.2 billion. They posted a 24.9% core return on equity, and this is their 8th consecutive quarter of underwriting income sitting above $1 billion. Plus, net written premiums hit $11.5 billion. I mean, it is just this undeniable display of financial dominance.
The math is absolutely bulletproof. And, when a company delivers that kind of quarterly performance, management gets this luxury that most leadership teams only dream of.
Which is what? Exactly.
But they don't have to spend a single second on the earnings call actually defending the spreadsheet.
Yeah.
The numbers just do all the heavy lifting for them.
Oh, right. They don't have to explain away bad results.
Exactly. Which means if you are trying to figure out what is actually happening in the executive suite, well, analyzing the math is no longer enough. You have to look elsewhere.
And I guess that brings us to the mission of today's deep dive. We are setting all that flawless math aside to analyze the corporate body language instead.
Yeah, the stuff they aren't explicitly saying with numbers.
Right. Specifically, we are diving into a gap report. We're tracking the narrative shift between what Travelers' leadership chose to emphasize 90 days ago in April versus what they actually ended up saying in July.
And this is huge.
It really is, because if you are listening to this right now, whether you are, an investor, a manager, or just someone trying to read between the lines at your own job, understanding how corporate narratives shift in real time is honestly a superpower.
Definitely. It's the difference between just blindly reading a press release and actually understanding the true temperature of the room.
So let's get into it. What was the temperature of the room back in April?
Well, to understand July, we really do have to rewind 90 days. In April, CEO Alan Schnitzer was operating from a distinctly defensive posture. The market was just throwing anxieties at him left and right.
Anxieties about what, mostly?
Mostly regarding elevated catastrophe losses, from all those winter storms we had, coupled with just broad macroeconomic uncertainty.
Yeah, everyone was worried about the macro stuff back then.
Right. So his communication strategy was basically holding up a historical shield. He kept pointing to the company's long-term track record, reminding everyone hey, Travelers survived the financial crisis, we survived the global pandemic, brutal rate cycles.
Kind of a we are built to withstand bad weather vibe.
Exactly. It was a narrative completely anchored in survival and historical resilience.
But then fast forward to July and the entire tune changed, right?
The shift was stark. Schnitzer totally moved away from defending the quarter and pivoted straight to claiming permanence. He introduced this whole framework of an earnings engine.
An earnings engine. That sounds very corporate.
Very. He said it was composed of 4 distinct cylinders. You've got underlying underwriting income, net investment income, catastrophe losses, and prior year development.
Let me jump in real quick to clarify that last one for you guys listening. Prior year development is basically when an insurer realizes that the claims from past years are, they're going to cost less than they originally set aside.
Right, so they have extra cash.
Yeah, allowing them to release that extra money back into their earnings. So Schnitzer is arguing that this 4-part engine is now so robust it can just absorb huge shocks and still generate leading returns.
That's the claim. And the scale they use to back this up is staggering. I mean, they pointed to a $100 billion investment portfolio.
Wow.
Yeah. They highlighted $15 billion in net favorable prior year reserve development over, get this, 19 of the last 20 years.
That is wild consistency.
And they threw in the fact that they've retired 70% of their outstanding shares since 2006. So management used this earnings call not just as a standard update, but as a total capital markets thesis. They were formally telling Wall Street, we haven't just had a lucky run. We have institutionalized our success.
Okay, let's unpack this. Because whenever a legacy corporation starts throwing around words like engine and permanent success, my radar just immediately goes off.
Oh, for sure.
Right. I mean, an engine implies something mechanical. It implies a machine that just runs flawlessly on autopilot, immune to human error or outside conditions. So is that the actual reality here, or are there warning lights flashing under the hood?
What's fascinating here is that beneath this grand public thesis of an unstoppable engine, the underlying financial mechanics show management is actually remaining highly cautious.
Really? Where do we see that?
We saw it play out in this very technical exchange between analyst Elise Greenspan and CFO Dan Frey. They were talking about something called a casualty uncertainty provision.
Okay, let's translate that real quick. A casualty uncertainty provision is essentially like an emergency vault, right?
That's a good way to put it.
An insurer locks away a chunk of capital specifically because they are worried about future unknowns for certain accident years. And in this specific case, it was for the years 2021 through 2023.
That is the exact mechanism. You lock that money away when you fear trends like social inflation, which is basically the tendency for jury verdicts and settlements to just skyrocket past historical norms.
Right, those nuclear verdicts you hear about.
Exactly. Now, during this second quarter, the business insurance segment actually saw a half-point improvement in its underlying loss ratio.
Okay, a half-point improvement is pretty good.
It is. So Greenspan asked a very logical question. She basically said, did you achieve that half-point improvement by quietly opening that emergency vault and releasing some of that rainy day provision back into your earnings?
Ah, I see. Because if the permanent earnings engine is running as perfectly as they claim it is, they really shouldn't need to hoard emergency capital for 2021 anymore. They could just release it and make the numbers look even better.
Precisely. But Frey's answer was an immediate no. He confirmed they carried the entirety of that uncertainty provision right through the first and second quarters of 2026.
So they didn't touch the safety net at all?
Not a dime. The half-point improvement came from actual pricing and operating efficiencies, not from unwinding their emergency vault. So yes, the engine is humming, but management absolutely refuses to take the emergency supplies out of the trunk.
It's like they're projecting absolute confidence on stage, but quietly maintaining an iron grip on their defensive buffers in the back office.
Exactly.
I just love catching that kind of contrast. It really forces us to ask, if this overarching engine is supposedly permanent, what happens when we look closer at the individual gears powering it? Because according to the sources we have, some of those gears are actually losing speed, aren't they?
Oh, definitely. Tracking the specific phrasing over a 90-day period reveals a lot of internal friction. Take personal insurance, for example.
Okay.
In April, the executive running that segment, Michael Klein, he concluded his section by highlighting, quote, early signs of growth momentum in both auto and home. It was this very forward-looking, highly energetic framing.
And by July, let me guess, the phrase early signs of growth momentum just vanished entirely from the transcript.
Vanished completely, replaced by much more grounded language. Growth in auto new business was downgraded from momentum to merely healthy.
That's a noticeable step down.
Yeah. Furthermore, their homeowners' renewal premium change, which basically tracks how much more customers are paying when their annual policies renew. That's set at 6.6%. But management explicitly guided that it is trending down to mid-single digits.
Ouch.
And when he was pushed by an analyst on how realistic growth actually is in the current competitive environment, Klein conceded that their outcome is now, quote, a little bit the function of the market.
It is honestly like watching a surfer change their story.
What do you mean?
Well, in April, Travelers was basically claiming they were paddling so hard they were generating their own momentum, right?
Yeah, exactly.
But by July, it's like they changed their relationship status to, it's complicated. They're shrugging and admitting they can really only ride whatever wave the market gives them.
That's a great analogy. And we see a similar narrative shift in business insurance property, too.
What happened there?
Well, Greg Toxidlowski described the softening in national property pricing back in April as this very contained, isolated issue. He framed it purely as a large account dynamic.
Okay, so just affecting the big players.
Right. But come July, he had to concede the market is actually, quote, incrementally softer, and that the pricing weakness is slightly spreading down into middle market property now.
Ah, so the rhetoric of containment is still there, but the actual zone they are trying to contain just keeps expanding?
Exactly.
But wait, if the unit growth metrics are softening and their pricing power on property is slipping, why does the overarching math still look so good?
Well, we are witnessing a textbook example of narrative inertia. The actual profitability remains exceptional.
How exceptional.
The personal insurance combined ratio hit 79.5%.
Wow.
Yeah. And just to give some context for you listening, a combined ratio measures an insurer's incurred losses and expenses against the premiums they actually collect.
Right. So anything under 100 means you are turning a profit on the underwriting itself, even before you factor in the investment income.
Exactly. So hitting 79.5 is just an extraordinary margin. The takeaway here is that Travelers isn't a company in trouble. They're a company actively choosing to throttle back on unit growth to protect that 79.5% margin, rather than, aggressively chasing new policies in a softening market.
I mean, that makes sense, but if traditional growth levers like aggressive pricing and sheer volume are slowing down, Travelers needs a different catalyst to keep their margins wide.
Right, they need a new trick.
And the sources indicate they're leaning heavily into what they brand as Innovation 2.0 and artificial intelligence. But looking at the gap between April and July, integrating AI into a legacy insurance behemoth is a pretty messy process.
Oh, it involves profound operational friction. But July did deliver a vital milestone for them.
What was it?
Well, in April, the conversation surrounding AI benefits was entirely prospective, right? Management spoke in terms of expected tailwinds and future capabilities.
Very theoretical.
Exactly. But in July, Schnitzer finally delivered hard evidence. He confirmed to analyst Rob Cox that AI-driven straight-through claims processing and predictive models were the direct causal driver of that half-point improvement in the business insurance underlying loss ratio that we discussed earlier.
Let me stop you there for a second. For the listener who doesn't live in the insurance trenches every day, straight-through claims processing means what exactly? Like, a claim is filed, assessed, and paid entirely by an algorithm without a human adjuster ever even looking at it.
Yeah, that is the goal. It removes the human friction and all the associated administrative costs from the simpler claims.
Okay, but even so, we are talking about a half-point improvement here. For a company pulling in $11.5 billion in quarterly premiums, why should we care about a half point? It just sounds like a rounding error.
I get why it sounds small, but in a portfolio of that immense size, a half point translates to a staggering amount of capital dropping directly to the bottom line.
Okay, fair enough. The math scales up.
It scales massively. But honestly, the strategic implications matter even more than the dollar amount.
How so?
Because it represents the crucial transition from theoretical promise to actual balance sheet reality. Moving an organization from, we think AI will make us efficient, to, here's the quantifiable proof that AI is widening our margins, is an enormous hurdle.
Yeah, I guess crossing that bridge is a big deal. So the proof of concept is officially paying dividends. But the sources also highlight that this victory lap featured some notable, well, evasions. Management found themselves backed into a corner during the Q&A.
They really did. Analyst Gregory Peters started probing the unglamorous side of AI. He brought up the rising token costs associated with running these massive language models.
Right, because AI isn't free.
Far from it. Every prompt, every document scanned uses tokens. And these tokens act like digital taxi meters charging fractions of a cent. Across millions and millions of insurance documents, that meter runs incredibly high.
I can only imagine.
So Peters asked about that, and he also asked about a rumored software glitch that had apparently disrupted operations.
Ooh, how did Schnitzer handle that?
It was a clinic in corporate deflection. He absolutely refused to use the word glitch. He entirely reframed the event as a complex system conversion involving vast amounts of data.
Ah, the classic, it is not a bug, it is a feature maneuver. I love it.
Exactly. He assured the analysts the team was, quote, laser-focused on the resolution. But he flat out refused to quantify the scope of the disruption or offer a timeline for a fix.
Very convenient.
And more tellingly, when he was pressed on how those rising AI token costs were eating into the efficiency gains, Schnitzer answered a hard quantitative question with a confident qualitative posture.
What did he say?
He stated the company was very comfortable with their execution without providing a single metric regarding the actual cost of their AI implementations.
It is such an obvious tell. I mean, they have the exact half-point metric locked and loaded when it highlights an AI victory, but the moment you ask for the receipt to see what the AI actually cost them, the numbers just vanish, and they just tell you how great they feel about it.
It's selective transparency at its finest.
Okay, here's where it gets really interesting. We've spent time analyzing what management injected into the July narrative. The earnings engine, the AI wins. But to make room for those shiny news stories, they quietly swept several old storylines under the rug. Let's look at the evaporated narratives.
Yes, because honestly, analyzing what executives stop talking about is often the most revealing part of a gap report. In April, Schnitzer spent significant time in his prepared remarks constructing this defensive shield around geopolitical complexity and macroeconomic risk.
Right, blaming the global environment.
Yeah, he warned about equity market lags and emphasized Travelers' concentration in North America as this safe haven from global volatility.
And in July?
Complete silence. And the reason lies in their non-fixed income net investment returns.
Okay, explain that term for us real quick. We know fixed income is safe stuff like bonds. What is non-fixed income?
Non-fixed income NII refers to their alternative investments, so things like private equity, real estate, hedge funds.
Hmm.
In April, those alternative investments were a huge source of anxiety. But by July, the returns from that portfolio actually rose, which resolved the issue favorably.
So once the math improved, the overarching macroeconomic excuse was just discarded entirely?
Exactly. Gone.
It's funny, corporate narratives are truly just tools in a toolbox. You pull out the geopolitical complexity wrench when you think your alternative investments might drag down your earnings. But the second the investments bounce back, you just throw the wrench back in the box and pretend you never even owned it.
That's a perfect way to put it. And, it wasn't just the macro environment that disappeared either.
What else vanished?
The narrative surrounding tort reform also evaporated.
Okay, and just as a quick reminder to you listening, our aim here is to impartially report on the source material. We aren't here to validate or invalidate the politics of litigation abuse. We are purely examining how management leverages these topics as communication tools.
Exactly. We are just looking at the mechanics of the narrative,
Yeah.
not taking a side on the politics.
Right. So what happened with the tort reform narrative?
Well, in April, management proactively delivered this really enthusiastic update on a state-by-state ground game aimed at fighting litigation abuse. They were touting all this legislative and legal momentum in Florida, Georgia, Texas, Louisiana, and South Carolina.
Wow, they were really pushing it.
They were. It was framed as a primary structural priority for the entire company. But come July,
Let me guess. Crickets.
the entire initiative was absent. It was missing from the prepared remarks and entirely bypassed during the Q&A.
It is just so jarring to watch a major structural initiative simply fall off the radar in 90 days.
It is. And there was actually a third vanishing act, too.
What was that?
The Canadian business sale. In April, the sale of their Canadian business required these really intricate operational accounting explanations.
Because selling a chunk of the business messes up the year-over-year comparisons.
Exactly. It creates a hole in the premium comparisons. Management had to spend all this time explaining how to model around this gap to prove their underlying growth was still healthy.
And in July?
By July, the anniversary of the sale had passed. The accounting noise settled, and this massive, complex transaction was reduced to a passing footnote, merely used to contextualize a 5% growth statistic in business insurance.
Wow. It perfectly illustrates how a complex operational hurdle basically just transforms into background noise the moment the ledger balances out.
Yep, once the math works, the story disappears.
But ultimately, all of this, the abandoned excuses, the AI efficiency games, the incredible profit margins we talked about, it all funnels into one central, almost comical problem for travelers.
Which is?
What does a corporate giant do when it is entirely too successful?
It is literally the definition of a luxury problem.
Yeah.
We noted earlier their trailing 12-month core return on equity sits at 24.2%.
Right.
But their stated long-term target is merely the mid-teens, so they are just obliterating their own benchmarks, which creates a fascinating tension between management and the analysts covering them.
Oh, I bet. Analyst Gregory Peters actually stepped up and bluntly asked, you have all this excess return. Are you going to relax your underwriting standards to grow your market share faster?
And Schnitzer shut that premise down instantly. He repeated his answer twice for emphasis, actually, stating that's a fool's errand. We've always said that's a fool's errand.
It was a deeply ingrained statement of corporate identity. Like,
Yeah.
we do not do that here.
Exactly. But the tension didn't end there. Another analyst, Meyer Shields, approached the same exact problem, but from a different angle.
What did he ask?
He asked if travelers could use their massive cost advantages, like those AI efficiencies we discussed, to lower their prices for the consumer without impairing their overall returns.
Ah, that is a crucial distinction. Lowering prices because you can afford it, not because you're reckless.
Right. And Schnitzer acknowledged the nuance. Passing along structural savings to the consumer to remain competitive, well, that's just standard business practice. But he aggressively distinguished that from the reckless practice of artificially suppressing prices or abandoning underwriting discipline simply to hoard market share.
Okay, so what does this all mean for you? If you are listening and wondering why you should care how an insurance conglomerate manages a surplus of capital, how does this actually apply outside of Wall Street?
Well, if we connect this to the bigger picture, management is demonstrating the capital return flywheel. They are broadcasting a signal of ironclad discipline.
Which is pretty rare, honestly.
It is. When any company is flush with cash, The internal temptation to chase bad growth, to just lower your standards just to report a bigger revenue number, is immense.
Oh, absolute.
But by labeling that pursuit a fool's errand, Travelers is making a public commitment. They are saying they will generate capital, reinvest it strictly where returns remain highly attractive, and return the excess to shareholders. They flatly refuse to degrade their own business quality just to buy a larger slice of the market.
That level of restraint is rare, and we actually saw that exact discipline mirrored in their bond and specialty division, didn't we?
We did. Their Surety segment, which basically guarantees large contracts, often in construction, saw an unbelievable 40% growth in net written premiums.
40%.
Yeah. Yet the executive running that division, Jeff Klink, adamantly refused to project that spike as a durable trend. He openly admitted the growth was just an anomaly driven by a small number of very large projects.
Man, that disciplined communication builds so much institutional trust. They absolutely refuse to overpromise on anomalous data, even when the anomaly makes them look incredibly good.
Exactly. They won't take the bait.
Let's bring all these threads together here. We started by looking at a mathematically flawless quarter, but by analyzing the gap in the corporate body language, a deeper story emerged. We watched Travelers pivot from a defensive crouch in April to claiming a permanent earnings engine in July.
Yep.
We saw them finally prove AI is generating hard margin improvements, even as they dodged all those questions about the operational costs. We watched them quietly retire old excuses about macroeconomics and tort reform. And finally, we saw how a truly disciplined company handles the rare burden of excess success.
It's a lot. Yet even with all of that institutional discipline, the landscape of risk is always evolving, which actually brings up one final, entirely novel thread raised during the July call that wasn't even a whisper 90 days ago.
Oh, these curveball questions from analysts are always the best part. What did they ask?
An analyst introduced a really fascinating question right at the intersection of workers' compensation claims and artificial intelligence.
Okay, I'm intrigued.
The premise was based on a macroeconomic fear, they asked. Could the rise of AI actually extend the physical recovery timelines for workers' compensation claims?
Wait, how would that even work?
The underlying theory is deeply psychological. Imagine an injured employee sitting at home. They might consciously or even subconsciously delay returning to the workforce because they are experiencing acute dread that AI is going to replace their job while they are gone.
Wow. So the psychological anxiety of technological displacement actually manifests as a delayed physical return to work.
Exactly.
That is a profound ripple effect. How did management even respond to a theory like that?
Well, CFO Dan Frey acknowledged the theory, but he noted they haven't seen any empirical data in their current claims manifesting this trend yet. However, he confirmed it is officially on the company's radar as a monitoring item.
So they are watching it.
Oh, yeah. It represents an entirely new behavioral variable injected straight into their risk models.
That is exactly the kind of unexpected consequence that makes analyzing these gap reports so rewarding. I mean, consider how the psychological fear of technological displacement might be quietly impacting the workforce dynamics in your own industry. That is definitely a thought worth bringing to your next strategy meeting.
Absolutely.
Also, just real quick, keep an eye on a quiet structural move buried in the margins. Travelers recently restructured their personal lines reinsurance. They officially dropped their CAT XOL treaty in favor of an enterprise-wide approach.
And for those wondering, a CAT XOL, or Catastrophe Excess of Loss Treaty, is essentially the massive deductible policy an insurer buys to protect themselves against a hurricane or a major wildfire.
Right. So shifting from a specific personal line safety net to a broader corporate one is a highly technical move, but one that will absolutely matter when we analyze their catastrophe losses next quarter.
It really drives home the core lesson of this entire analysis, honestly.
Yeah.
A company's math can look absolutely flawless, but the real narrative, the complex, friction-filled reality of steering a massive organization is always waiting to be found in the gaps between what they say and what they do.
Well said. The spreadsheets will only tell you what happened. You have to read the body language to understand how and why. Keep looking for those gaps and we will catch you on the next deep dive.